Hey everyone! With today's video lesson, we're launching the Quick Start project. As promised, you have access to 5 video lessons dedicated to the American Stock Exchange. We strongly recommend that you watch the videos in the chronological order we've specially designed for you. Now, let's get down to business. Lesson number 1 will cover the following topics. We'll talk about types of orders, find out what ECN is, discuss the Uptick Rule, and break down the commission structure. All right, let's take it step by step. An order means that your action is sent to the exchange to fulfill your transactional needs. In the past, this procedure required a phone call or even being there in person, but now it's enough to press a few keys in the trading terminal. The most commonly used types of orders at the moment are the following. These are limit orders, market orders, and a variety, stop orders. And to understand how they work and what makes them different, we need to introduce the concept of a quote. In reality, behind this complicated term is just a simple line of numbers that you've almost certainly seen when passing by a currency exchange booth on the street. On the electronic board near the entrance, you see 2 numbers, say 60 and 60.30 for $1. The first number is the price at which the exchange buys. The second is the price at which it sells. The difference between these prices is 30 cents. Traders call this the spread. So if someone sells $1,000 to the exchange at 60, and someone else buys from the same exchange at 60.30, those 30 cents become their profit. The scheme is really simple. Pretty much the same thing happens with stock quotes, except there might be a few more numbers involved there. In the classic version, say, using Apple stock as an example, it looks like this. Here, the spread is 30 cents, and the numbers 3 and 5 on the right indicate the volume currently available for buying or selling. Traditionally, it's accepted that 1 unit in the quote equals 1 lot, or 100 shares. So in our case, we can buy 500 shares of Apple at $135.80 per share. So, how exactly does the process of buying shares work? The first option, using a market order, means that you agree to the price currently available on the market. If we set aside some nuances, by sending a market order to buy 300 shares, we will get them at the price of $135.80. At the same time, the quote will look as follows. Accordingly, the offer or the seller's price will decrease by 3 lots or 300 shares because you bought them. The second option is the process of buying with a limit order. Unlike a market order, you set the price at which you're willing to buy the stock, and you don't experience any slippage. But there's a pretty big chance that you might not get the position if no one is willing to fill your order. Accordingly, if you make this decision, the quote will look like this. That is, we can see that your 3 lots have been added to the bid, the buyer's price. But you'll only get this order if your turn comes, which is very different from a market order, where you get it guaranteed. The third option, using a stop order, usually means you're using it most often to lock in losses. Let's say you already have a position in Apple at a price of $130. The current price, accordingly, is $135, and you don't want to monitor this position all the time just to, say, sell it at $133 and take the profit if needed. That's where a sell-stop market order comes to your rescue. You set it at $133. And as soon as the price drops from $135 to $133, your sell order will be triggered automatically, just like with a regular market order. Remember, market and stop orders only work when the market is open and are automatically canceled if the exchange is closed. Limit orders also have a certain duration. And if it's not a GTC, good till cancel, then they will be canceled about 2 or 3 hours after the bell. There are quite a few pros and cons to using different types of orders. So it's best to use the type that suits your needs at the moment. Now let's talk about ECN. That stands for Electronic Communication Network. Essentially, it's a network of exchanges combined into a single window system, where you, as a consumer, can buy any package of shares you need. The system is set up in such a way that several electronic liquidity providers operate within it. The most well-known are ERCA, BETS, EDGX, and NASDAQ. All of them function like one big exchange and offer you the best prices. Let me put it this way. There's really no need to stress over which ECN is best to use right now. Most often, we use routings, sort of smart orders that send requests to all exchanges, allowing you to minimize costs and get the best prices. And since we're on the topic of costs, let's list the main ones. The first item is the cost of the trading platform. The thing is, a lot of beginners, chasing after fancy features and technical perfection, end up buying expensive, overloaded platforms. I assure you, our trading platform has absolutely all the necessary features. The second is the broker's commission. Believe me, the company offers you very good terms in this regard. Of course, a lot depends on which tariff plan you are trading on and the number of shares you have traded. That's why it's best to clarify these figures with your manager. The third is the exchange commission, or so-called fees. The thing is, absolutely all traders, regardless of age, location, or trading style, pay them. These include fees from the exchange and regulatory organizations. For your convenience, fees, just like broker commissions, are already factored into the trading platform. Remember, the net trading result is called net, while the gross result, without taking these into account, is called gross. Accordingly, traders are paid exclusively from net profits. Now let's discuss a very important point, which is quite rarely understood by beginners. The thing is, the principle of buying stocks at a lower price and selling them at a higher price is clear. You pocket the difference, but the exchange also gives you the opportunity to profit from a decline. This is called a short position. In other words, the broker kind of lends you something you don't have and requires you to buy it back after some time. So if you expect Apple to drop, you can short it at a price of $135 and cover that short at $133. That means, on a minimum lot of 100 shares, you make 2 points or 200 cents per share. In money, that's $200. But unfortunately, the opportunity to get a short is not always guaranteed. This happens because of the broker. This is called hard to borrow. And the platform will notify you about this. The Uptick Rule also imposes certain restrictions on short selling of stocks. The thing is, if the issuer drops by 10% during a trading session, you can only get a short position if someone buys from you. Unlike a classic short, where you can immediately hit the bid. This rule is in effect for 2 trading sessions, that is, today and tomorrow. If on the second day the stock also doesn't drop by those same 10%, then the Uptick Rule is turned off. Don't confuse HTB and the Uptick Rule. HTB can't be shorted at all, while the Uptick Rule only applies if someone buys your lot. Of course, there are a lot of nuances. If you haven't fully figured them out yet, I recommend you avoid trading such stocks altogether. Let's sum things up a bit. Almost all trading is done through market, limit, and stop orders. You can not only buy stocks, but also short them. The expenses in this case consist of 3 parts: the cost of software, commissions, and fees. That concludes our lesson. See you in the next class.